I'm historically a fucking terrible trader. I don't trade stocks anymore because everything that made sense never worked. And I think in doing the show and talking to people like you, I've realized I'm trading rationality. I should be trading political cycles.
That's not a bad trade.
Because if you're saying the tax receipts are going to be dropping and then corporate earnings are going to be dropping, that would be saying to you, well, I should be selling these shares. And maybe they will. And then that's the time to buy when the blood's on the streets because they're going to pump the money into the market. Is that what you're basically saying?
Pete, I would recharacterize it as you were acting as if we're in free and open markets.
Yes.
When in fact we're nothing of the sort. Right?
Yeah.
And I think that, boy, have I made that mistake for a really long time in my life. Like where I thought I was operating in this world where like these antics, these $1 trillion antics weren't happening, and that I was positioning myself as if I was in a free and open market when I wasn't.
Yeah. But let's pull on that thread a little bit, right? So you would think, okay, well, short everything.
Yeah.
Right? Like short everything, right? But you can't because you have what we saw in 2020, that V recovery because of the money printing. So let's talk through that though. But you go back to when this started, it was in 1987 when the market crashed, Black Monday, right? I was in high school. But I remember this and I remember everybody freaking out, right? But what happened was Greenspan came in, and you remember this from your research, but Greenspan came in and said, we will do everything to make sure that the markets don't collapse. They didn't really do anything, but they said they would, right? So now flash forward. You flash forward to 1998, right? And long-term capital management, they were putting on these geniuses who actually won Nobel Prize. They were Nobel Prize winners for the economics Nobel Prize, nothing. But they won for the Black-Scholes model, the options pricing model. I mean, these guys were smart, right? But they were levered. How much were they levered? They estimate about 100 to 1. So they had $1 billion of capital in their firm, and they had about $100 billion that they could figure out on swaps on something called an interest rate trade. It was they were basically shorting volatility in bonds, right? And so when you had the Russian ruble crisis and bond spreads blew out, they got obliterated. The street started hearing about it, and they blew up in a matter of days, right? So what happened was the head of Goldman, right, was they were in a panic. So I was getting calls from this. I was in the market this time. I was in an arbitrage trading firm, and I had some of the trades on. They were blowing out. Like, what is going on here? And we knew that long term was blowing up. So we were adding to the positions. No, we had capital. We were fine. We weren't levered. But I got a phone call from one of the biggest hedge funds in Texas, and they said, hey, do you guys have any assets at Goldman? And I was like, no, we're not using them as a prime broker. And they said, well, if you have any counterparty risk with them, get out today because they're going to blow up. This is Goldman. So
they wouldn't let Goldman blow up.
The head of Goldman went to the head of the New York Fed and said, we're going to blow up. We need help. And so they assembled a room full of heads of the banks, and they basically engineered a bailout for Goldman. Okay, so this is where it started. So, well, it started in 1987. Then they put it into effect. They're like, okay, we can make sure that the banking system's okay. Our buddies over at Goldman, we got to make sure that they don't blow up because it could have taken down the street. We're talking about counterparty and contagion, counterparty risk and contagion that would have spread everywhere, right? So that's where it kind of started. And then you flash forward to 2008, and it was a full-on rescue the entire, banking industry because
and it's been that way ever since.
And it's only to Preston's point. The whole point of this is it's only compounded since because the market has learned that certain players have learned that they're big enough. They can be irresponsible with their debt loads. And there's the sheer amount of credit they have, and they'll be bailed out. And so that's what the market has learned. And so the rational market would say, short everything. The real market, the insiders say, oh no, we'll get bailed out.
Well, here's the really crazy part. So everything we've talked about, this is the best G7 currency.